Good morning, everyone. Mark Cavari here, taking a look at Rate Watch, the mortgage-backed security market. When they go up, rates go down. When they go down, rates go up. So let's take a look at where we are today. We are, as you can see here, we've opened here. Yesterday we had this big fat candlestick all the way up. Rates were down, and as a consequence, rates went down a little bit. And we're at this 102 level. This 102 level. As you can see here, we've actually opened at 102.13, and currently it's trading just a little bit above that right now. I think that's an important line to look at as far as how it translates to the most favorable rates and what you should be thinking of in terms of some decision making. Look, this is the 1 month look at the 102 level. Obviously, we haven't been there all month for a month. The 3 months level, takes back to, we weren't at this kind of level of rates, favorable rates until since October. But if you look at the maximum, which takes us back to March of 2008, as you can see with this pop-up balloon, the 102 level, we've reached it and exceeded it just a few times. December of almost a year ago, a couple times this spring. But this 102 level and how that translates into our lower rates is really, really an important number. It doesn't look like there's a lot of pressure to go above that, and I think that's when you really want to look at what the fundamentals are, as we do here now. What would be driving rates up or down? Driving rates down, and actually I have it on both columns of rates up and down, is GDP. The report in is that GDP grew at 2.8%. They were looking for a 3% rate. That's down a little bit from the previous report of 3%. But hey, it's growth. It's not contraction. It's growth, i.e., we're out of the recession. So I think sometimes people will sober up and say it's growth. So growth is a good thing for the overall economy. It's not necessarily so good for rates. So I actually would probably ultimately remove this GDP from rates going down. In more of a longer term. The Case-Shiller Index, 9% decline in price values, but that's a nationwide. That's nationwide. Isn't different in the West, different in the North, different in the South. You know what I mean? But the volume of homes sold, as we saw the other day, is up substantially. So that's it's kind of a mixed bag there as well when you think about it. And then consumer confidence is up, which cause rates to go up. It's not like woohoo, up, but it is up. So that's something as well. So I think you see a lot of factors. There isn't any real demarcation point of why rates would be going down when you look at what's on the economic outlook here. So back to our graphs here. One of the things to follow oftentimes is what the 10-year Treasury is doing. Let's just take a look at that. Let it process here. You notice this. Remember, I pointed out the big fat candlestick all the way up yesterday on our MBS market. Notice the 10-year Treasury kind of mimics and kind of precedes and also mimics a lot oftentimes what the 30 years doing. And you can see here now what they have, how it's traded today also probably mimics a little bit about where we're at with the with the MBS market that we're following. So something to consider as you take a look at our pull down here. It's kind of 57% are thinking we should lock, 43% float. Again, that 102 level, it could go up a little. It's not going to go up substantially. It's just not. So that's something to keep in mind. It could go up a little bit. You could catch a little bit of a wave, but it's not going to be. But when it comes down, it usually comes down pretty hard. So that's something to take a look at. Anyways, hope you found this information helpful. Have a good day, everybody. Thanks.